My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. Just trying to make you some money. My job is not just to entertain you, but to educate, teach. Call me, 1-800-743-CBC, or tweet me at Jim Cramer. All right, this margin call situation, and everybody freaked out today. So you know what they did? They circled back to the stay-at-home stocks that had been in bear market territory. That, plus a stern warning from the head of the CDC about the pandemic. Explain today's action. Dow gaining 98 points. S&P declining 0.09%. And the NASDAQ lost 0.60%. Look, I know that sounds like a silly, if not even just kind of glib analysis of the fallout from this giant hedge fund and an emotional plea from the head of the CDC to keep your guard up or else. But it is precisely what caused the action today. A mysterious family office. And family office means you got a real rich person who works out of an office, okay? Let's not mystify this thing. Archegos, that's mystifying enough already. Run by a gentleman by the name of Bill Wang, borrowed a bunch of money, billions, and then blew up. Somehow this guy was able to hoodwink nearly every firm on Wall Street, borrowing huge sums of money in order to take down some very concentrated positions, mostly in Chinese stocks like Baidu and Tencent Music, along with some American media companies like Viacom and Discovery that have been rocket ships for months. When Viacom did a big secondary offering last week, I think this caused a lot of it. Stock got pulverized. It cut in half. This fund didn't have the extra cash to meet its margin obligations. It was obviously borrowing a lot of money. So the brokers repossessed everything and dumped it on the open market. And I wish I had the option to write the screenplay. Because it's like no one could believe it could be this. Well, no one's going to believe it's true. The liquidation dinged a bunch of banks, especially Credit Suisse and Nomura, with the former actually saying it endured highly significant losses. Goldman Sachs told us its losses were immaterial, but there's enough guesswork about the rest of Wall Street that the great reopening trade took a real breather today. You know, that had been centered on the banks. And, by the way, what is it with the foreign banks that they still have such horrendous risk controls? I mean, honestly. Now, I heard a lot of fretting about what the Archegos debacle might mean for the stock market. I don't think it's going to mean anything, except that this one fund got away with some outrageous actions, and maybe some of the investment banks need to figure out better ways to judge their exposure to potentially rogue accounts. And this firm did have a checkered history that seemed to go unflagged by many firms who should have known better. But you know what? Those commission dollars, oh, they're so great. Until they crush you. See, it wouldn't shock me if some heads roll. They have to because of this debacle, because there's some people who got so greedy that they have to be punished. At the same time that Archegos was ruining the earnings of a bunch of investment banks, we got a frightening whiff of fear about resurgent COVID infections, suggesting that maybe the reopening trade could be a little premature, even as we're now vaccinating 3 million people a day. I think the fear of new strains makes perfect sense, and many states have jumped the gun, reopening nearly everything before enough people are vaccinated. Apparently, the head of the CDC, Rochelle Walensky, feels that same way, but in a more poignant fashion. She says there could be a fourth wave of COVID and warned of, I quote, impending doom. Now, that turn of phrase crushed the restaurant stocks, the live entertainment place that have been flying for months now, the travel place, the entertainment place, the oil place, and the big cyclicals got hurt, too. Investors didn't just dump everything, though. That's not how this market works. This market's always robbing Peter to pay Paul. Today, Peter's the great reopening plays, and Paul's the stay-at-home stocks that have done, well, let's say they've spent months in the doghouse, right? No one wants to stay at home until today. It is really a strange situation, given that Goldman Sachs is talking about 10% GDP growth next quarter, and there's a widespread belief that we're about to have a repeat of the roaring 20s when the economy snapped back as the world recovered from the Spanish flu pandemic. Today's move is this is what's called a counter-trend move. A market led by Clorox, Procter & Gamble, Kimberly-Clark, and Amgen is a market that only makes sense if we're about to head back into a lockdown in a recession, like they're doing in Germany. Seems unlikely to me. Those stocks have seen better days, and I don't think they'll make a ton of sense here, although they've fallen so far behind the rest of the market that maybe they deserve to play catch-up. I respect that Johnson & Johnson has a terrific pipeline, but its recent run seems very exaggerated. Those rotations have a lot of power. General Mills got gaffed last week on a not-so-hot quarter, but the specter of impending doom can get any cereal stock going, and now it's higher than when it reported. That is extraordinary. Last week, the legendary Larry Williams suggested buying Walmart and Costco right before the Easter holiday because they tend to do very well this time of the year. Voila! Both stocks took off. Remember, these are essential retailers, and the rallies came at the expense of the non-essential stores like the Kohl's and Nordstrom. Again, we're robbing Peter to pay Paul. I think Walmart and Costco have been punished enough for being lockdown stocks. They should have terrific numbers this year. They are not done. They deserve to be in your portfolio. Come on, Costco? You sell Costco now? Walmart? It's down big. The honest part of this rotation, though, is the remarkable resurgence of FANG, Facebook, Amazon, Netflix, and Google. Some of this could be pent-up demand. Facebook caught a couple of positive research reports today. Last week, CEO Mark Zuckerberg faced Congress in what I can only call a confused hearing about how to regulate social media. Once the smoke cleared, you had to expect some analysts to come out of the woodwork and bull Facebook stock higher because this Congress likely won't do anything that's going to hurt Facebook's earnings. Now, here's an astonishing thing. This company's growth is accelerating. It sells at just 21.6 times next year's earnings estimates, cheaper than any consumer product stock I follow. Amazon's part of a not-so-quick-to-reopen trade because it's the retailer of choice for everyone who's stuck at home. Remember those days when you were stuck at home? Alphabet, the parent of Google, is kind of two-faced. It's a great reopening play because it makes a lot of money selling travel advertisers. But when the stay-at-home stocks rally, it tends to get dragged along with them. A lot of that's the ETFs. Still, I'm betting that this counter-trend rally will not have legs. When you look at the stocks that got hit today, I don't think they're going to stay down. The cyclicals sold off from those emotionally charged, highly personal, and downright scary comments from the CDC chief. Those shook me to the core. If she hadn't dropped that line about impending doom, we might have spent more time considering the possibility that the whole country could be vaccinated by May, or at least the part of the country that's willing to get shot. So much for success. Tomorrow, my guess is we'll forget about Archegos and begin to distance ourselves from these impending doom comments. Oh, there's still probably some Archegos fallout, but you know what I mean. Archegos, we're going to say like, oh, yeah, what was that Archegos? The great reopening trade should come right back. So I take a hard look at Disney and Boeing. The accelerated vaccination timetable means Disney's movie and theme park businesses can go back to normal sooner than we expected. Meanwhile, Boeing just won a big order from Southwest Air that was supposed to go, frankly, to Airbus. The 787 Dreamliner was just approved for sale by the FAA after a multi-month suspension. These are huge positives, and I think the stock would have rallied a lot more than 2% if we hadn't spent the whole day worrying about impending doom. By the way, I like the banks now. They're coming down. We just have to hear from every one of them before we can get involved. But the most important lesson today is that this market is fickle. So don't dump the counter-trend stocks when they're going down. If you're patient, there's almost always a better time. Today was that better time. Bottom line, sooner or later, the rotation will change directions, meaning money will flow back to the great reopening stocks, the banks, and the cyclicals. So you want to use days like today and perhaps tomorrow to buy them into weakness while you trim your positions into the lockdown stocks. Because I got a news flash. We are not Germany. We are ahead of almost every other nation in the world. And that's something to be proud of, even if we don't want to be the last people to die in the great 2020-2021 COVID-19 pandemic.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.